Let's continue talking about financial operations. Now, financial operations is very different from accounting. Accounting, you're looking at the money, you're making certain you're tracking it where it's going. Financing, a lot of it is actually using the money as a tool, leveraging it, so to speak, to meet the needs of the organization. Anywhere from daily operations like we're talking about here, all the way to big picture, talking about long-term expenditures, capital equipment, and so on. So when you think about some of the aspects of how we do it in retail stores, 40% of all revenue takes place 3 months out of the year, October, November, December, because of the holiday season. So how do you go about leveraging everything to have your money in place so you purchase the different items? You don't go out in the month of October and go buy stuff to sell. That actually is a long-term planning process. You're actually ordering for the month of October in the months of January, February, and March. Well, when you order it, do you have the money in your bank account to sit down and pay for it back in January, February, March, knowing that it's going to be a 3 to 4 month process to receive the goods in time to sell them for that busy holiday season where 40% of your whole year's revenue is picked up? You have to get loans. You have to sit down and line up the loans ahead of time and also buy on credit. And then when you receive the revenue, remember to pay it off in a timely fashion to avoid high payments. And then on top of it, then you have January, and typically retail sales slow down, or their liquidation sales, where the profit volume you receive from the sales in January and even February is much lower than you would in October, November, December. So you have to sit down and pay attention to it. How does a car, when you deal with a car dealership, they have 100 cars on their lot today. Well, at the end of the month, they might have 100 cars also, but they might have sold 60 cars, acquired 40 cars in one shipment and 20 cars in another. So how do you track that? You have this weighted average you have to sit down and pay for. So you have to sit down and balance this aspect. So pay attention to how each organization will have a different way that they finance it. A lot of times you have a secured loan. By secured, we're talking about it's backed by some type of collateral. When you buy a car, you actually have a physical product sitting on your lot. When you get a house, you're backing up the mortgage, and that's why a mortgage rate is so much lower typically than you have for a commercial rate with a house. Now, does the bank want to own your house? No, but if you default on the loan, they do have a legal right to take over the house in a repossession. Other times, you might have an unsecured loan, and it depends upon your business. Typically, nobody's going to help you with an unsecured loan until you've been in business for 3 years. So don't expect anybody to sit down and do you a favor by saying, oh yeah, I like your smile, I'm going to give you some money. No, it doesn't work that way. They want to have something to tie it into in case things go sideways for you. Sometimes you also have a line of credit where it's unsecured, and the bank's promising to lend, provide funds readily available, and you'll have some type of link. Sometimes it's secured. But did you know that for the most part, if you're renting a storefront space from a landlord, the landlord will probably put a lien on your personal house? Yes, welcome to small business. Everybody wants to make certain their money has a safeguard behind it, and you might be able to get an unsecured loan or a line of credit, but typically not unless they can depend on you being around for a long period of time. For a house, they can always sit down and take your car or your house, whichever it may be. If you have a car loan, they can take your car, house, they can take your house on top of that. But they really don't want to deal with that because it ticks off an awful lot of people. And on top of it, the house doesn't want to be sold through a bank. It wants to be sold by you so you can make some money off of it if at all possible. And the bank doesn't want to sit down and repossess anything at all. It's called collateral and a way to pay things back. Securing capital is the lifeblood for launching and expanding a small business. A lot of times you want to go off, but you're so small as an individual, you have to have somebody giving you money through either buying stock, and that's where you sell stock, but then every time you sell stock, you're also selling part ownership of the company, or it's a matter of a bank can put a lien upon your house, put a lien on your business, depends what it might be. A traditional bank, or they'll have some type of collateral they might be able to get a co-author for a loan with the SBA, Small Business Administration, but they're looking for certain criteria as well. A lot of banks will be looking for a guarantee. In California, we have a methodology where you can actually have the state guarantee a loan up to 70%. With the federal government, you can get a loan guarantee often for up to 90%. Now they're not giving you the loan, they're guaranteeing that the loan can be repaid to a bank. So you have opportunities, but you have to look for them, and nobody comes knocking on your door. You have to go through and pursue it, making sure you can have that as well. Be careful about private sector firms wanting to say, oh, we'll give you money. Yeah, they're going to give you money, but they're going to want something in return. Make certain you understand what they want for the return. Now, sometimes when you get in the bind, you have an accounts receivable. Accounts receivable, once they go over 30 days, they become hard to collect. If you've been in business any more than a couple years, I promise you, you will have an account receivable that's always frustrating, at least one account that'll sit down and rattle your cage. And so you want to go rattle their cage. So you want to sit down and give them a couple phone calls, say, hey, you may want to sue them in small claims court. Now, sometimes it's more work than it's worth, but sometimes you just can't get anything out of a rock. If the rock doesn't have any money, the rock's not going to pay you. So you may be able to win a case in small claims court because a lot of small creditors simply don't have the gusto to respond to it, but they may not have any money. If they don't have any money, you're going to get it. So sometimes you sell the accounts receivable to a group. Here's $100,000, and you have old stale accounts. Everything is 90 days older or older than that. By that point, the chance of receiving 100% is zero. Okay, even if you have the best collectors on things. So you may sit down and take your $100,000 in unpaid bills and sell them to somebody and say, hey, I'll sell this to you. What do you give me for them? I'll give you $30,000. $30,000. No. Okay, you get all upset about it, but that might be what you get. You might be able to talk them into $40,000, but the chance of collecting all $100,000 at that point, if it's in 90 days, it hasn't been paid, is pretty much zero. So they're going to collect some of it. So they buy it. They give you whatever you agree upon. Let's say you got them to $40,000 for $100,000. They can sit down and it'll be a gamble for them. They have to collect their $40,000 at least out of that, plus 5, 6, or 10 more, or whatever they can possibly do. Now, the people that buy this and the factors, they're usually not very nice people to the ones on the phone. They just go after them hook, line, and sinker and get whatever they can out of the process, including suing them and so on. But we call that factoring. Sometimes people will sell their accounts receivable to somebody else that goes out and collects them. We call that factoring. Sometimes for short-term financing, you can get an unsecured promissory note. A lot of times these come due in 270 days. You'll notice that fits well with the idea of buying goods in March and April for your busy season in the fall, October, November, December. So sometimes you get commercial paper. Sometimes you use credit cards. A third of all small firms use them, and they just drive themselves into debt. I don't recommend that if at all possible. Figure out what you're trying to do and do it well. Crowdfunding. I used to make fun of crowdfunding, and then you had a couple TV shows that ended up having out there. One of them is called Chosen. That's the first time I paid attention to crowdfunding as a source, and boom, all of a sudden they raised enough money and people were happy with what they had for crowdfunding. See if you have that out there as an opportunity, but you have to have something that people believe in, not just lining your pockets with profit, but if it's a cause, they're much more in tune with the possibility of crowdfunding that. Sometimes you seek out microfinancing, and that's from literally short people. You talk to little short people. No, there's no short people that are that short. Okay, so figure out microfinancing is for a small firm. You know, surprisingly, there's a couple of banks that'll loan money for a teeny tiny business of $300 to $1,000 just to help them boost them off the ground. And they may not receive that much money back in payment from it, but it might be one of those altruistic aspects of a branch of a bank. You may have that as an opportunity depending what it's out there. Sometimes use asset-based lending where you're going to have something as collateral or even factoring, or sweet talk a vendor if you want to do business. Hey, I'm going to be doing this. You'll be my exclusive vendor if you do this. I need financing for $100,000 or a guarantee of fix my equipment. Ask family and friends. Really go out and raise capital. But if you don't have a business plan, Nobody's going to give you anything, including Uncle Fred and Aunt Wilma. The company doesn't need to know how much to recover from a lender. No, you need to have an idea as to how much money. You should have a 3-year business plan if you're pursuing getting loans from people, and make certain that you look honest and you're a person of integrity they can trust, not a poor credit risk in the process. Sometimes one of the biggest problems you have with a small business is you're undercapitalized when you first start. So make certain you know what collateral is, make sure you know what they're looking for collateral, and different industries have different financing needs. A service sector company, you may have almost nothing except for the fact of labor for yourself and one person, but it's a matter of you're producing the product, you may have to buy the machinery and rent a shop. It just depends what you have. Know what a secured loan is versus unsecured loan, and also know the concept of what factoring is. Financial operations, to some extent, you got to make certain you can pay the bills. Otherwise, your company is going to go belly up. And for most entrepreneurs, this area is one of the toughest ones because they tend to be scrambling nonstop trying to make ends meet. So make certain you have somebody that is really sharp that can hold the financial operations in hand for you as a business owner. Take care.